today I want to talk about home equity line of credits, or HELOCs as they're commonly referred to, and the deductibility on that. There's been a lot of questions about that. You can search the internet. Prior to 2018, when the TCJA, or the Tax Cut and Jobs Act, was implemented, it was all pretty straightforward. You could deduct home equity line of credit indebtedness up to $100,000 on a HELOC. You deduct that as qualified residence interest, and it was deductible on Schedule A, and it didn't matter what you did with the money. It was fine. The TCJA came along and basically said you can no longer deduct home equity indebtedness unless it is used for the acquisition or improvement of that same residence. So that changed things quite significantly, and there was no grandfathering of that either. And so, you may have had $100,000 on your home equity line of credit well before the tax law changed. And, maybe you used it to consolidate debt. Maybe you used it to buy a car. Maybe you used it to pay off credit cards or student loans or whatever. And you were deducting that on Schedule A because it was under $100,000 or up to the $100,000 interest charges. And then, the TCJA comes along and you can no longer deduct that interest at all. So you have $100,000 debt, you're paying interest on that, it's no longer deductible because it wasn't used for acquisition or improvement of that home. And that's where we find ourselves now. And on the surface, that change sounds pretty straightforward, but a lot of questions come up around that. So, for example, can I take out a $100,000 home equity line of credit debt and use the proceeds to buy a rental property? Can I use those proceeds to buy a vacation property? You can purchase a vacation home, and as long as debt in the aggregate between your primary residence and your vacation home is $750,000 or less, acquisition indebtedness can be deductible. And so people think, well, can I take let's say I have $500,000 on my primary residence and I get a $250,000 HELOC to use as down payment on my vacation home. Can I deduct that as well? And the short answer is no. And the reason for that is, even though it is acquisition indebtedness for a home that would otherwise qualify, you can use it for a first acquisition indebtedness, or qualified residence interest debt can be on a primary or a second home. The problem here is the debt itself isn't secured by the home for which it was used to purchase. So in this case, the debt is secured by your primary residence, but it was used to purchase the vacation home. So in that case, you have a non-deductible debt. And that's really a very difficult answer, but it is reality under the current scenario. And again, there's no grandfathering. You can't take debt that you had prior to 2018 and still get some deduction on that, by the way. And so let me just give you a couple of examples of deductible and non-deductible situations, and then there is the option, there's the possibility of deducting debt that you use for business purposes. But there's an election you have to make to do that if you secure it by your home. So let's start with a simple deductible example. You have $500,000 first mortgage, and you take a $250,000 home equity line of credit out to improve that same home. You do a massive improvement, you do a big nice new kitchen, you do an addition, whatever it is. Now you have a combined $750,000. All of that was used to either acquire or improve that property, and all of that is deductible interest. The first mortgage portion and the full $250,000 HELOC example interest portion, because it was all used. It was under the $750,000 cap, and was all used to either acquire or improve the property. Now let's look at a non-deductible, and this one we kind of touched on, but same as above, but the $250,000 that we take out now in the HELOC on your primary residence is used to improve or acquire a vacation home. In this case, that $250,000 HELOC generates non-deductible interest, and the reason for that is a vacation home is not a business purpose. The only reason you can deduct interest on a vacation home is because of the tax code that says you can deduct qualified residence interest. But in order for it to be qualified residence interest, the debt has to be secured by the same home. And in this case, the $250,000 is secured by the primary. It's used to purchase the vacation. So there you have a $250,000 non-deductible debt. And then the last example is kind of the tracing rules. Tracing rules existed prior to the 2018 tax law changes. And basic, tracing rules are really basic to all of debt. That basically says that the character and the nature of a debt is determined by what it's used for. And if you use a debt for a deductible purpose, then typically you can deduct it. So for example, let's take another example. Let's say that you have a $500,000 mortgage on your primary residence, and you take a $250,000 home equity line of credit for a down payment on a rental property. Now, a rental property is a business use, right? It's a deductible purpose. But there's a twist here, and that is you have to make an irrevocable election to treat that $250,000 HELOC as debt that's not secured by a home. And so as long as you make that election, you make an election that says, I'm irrevocably treating this home equity debt as not being used to secure a home, meaning that basically you can't go back then and deduct it as home equity indebtedness. Now, you couldn't anyway under the current rules, but you're making that election. You're saying, no, I'm permanently associating this with the purpose for which I used it for, the rental. In this case, you used it to buy a rental property. Then it's deductible on your Schedule E, which is where you would deduct rental income and expenses. Now, there's other uses you could do with it as well. Let's say you have a consulting business and you needed to acquire capital for this consulting business, or assets for this consulting business, or you needed working capital, whatever, and you use that $250,000 in your consulting business. Again, you have to make that election to treat that home equity line of credit that's secured by your primary residence as not being secured debt by a primary residence. You make that election, and then you can treat that interest as related to your business. So as you can see, it can get very complicated. It's not as simple as it used to be, but the basic rules are, home equity debt anymore is you have to attribute that to the purchase or improvement of the property for which it's secured by, and in that case it's deductible in your Schedule A just like it used to be, but if it's not used for those purposes, then it's typically not going to be deductible, with the main exception being if you used it for business purposes, then you can make an election to trace it to that, to associate it with that, and then you can potentially get that deduction. Hope that helps. Thanks so much.